Okay, so I'm going to demonstrate for you a similar problem to what you're going to be doing for homework, because I don't believe that this part of the chapter does a very good job of showing you actually how to work a problem when you're looking at two different investment options. So this chapter is a challenging chapter for students, and I do want to narrow down basically what you need to understand for this chapter. What I want you to understand for this chapter is I want you to understand the difference between tax planning, tax avoidance, and tax evasion. And then I want you to understand how to calculate and what is the definition of what is the idea of after-tax cost. So the amount of an investment or a strategy before taxes minus the amount of taxes, basically, right, where we consider the amount of taxes. And so I want you to understand how to look at an investment and understand that we have a before tax cost and then we have an after tax cost. And we're going to use a taxpayer's marginal tax rate to get to the amount of that after tax cost amount. So it's important that in this chapter that you understand the section that deals with tax rate terminology. So the calculation of tax liability, the understanding of what a tax base is, and also the understanding of the difference between a proportional tax rate and a progressive tax rate. In addition, I also want you to understand a regressive tax structure, and I need for you to understand the section that talks about marginal tax rate, average tax rate, nominal average tax rate, and effective tax rate. I will ask you to potentially calculate all four of those or understand those for the exam. The last part of the chapter goes through several examples of tax planning. While I think it's beneficial for you to read through and see the different types of opportunities that we have for tax planning, and I will test you on the idea that you can do tax planning through, for example, changing the timing of the recognition of income, etc. I will not ask you on the exam to calculate any of the information that's included in the tax planning section of this chapter. So I hope that narrows down kind of the scope of this chapter. This homework problem is a good example of what I might ask you to do on the exam. So I've created a similar homework problem or a similar problem for us to go over here. So the homework problem that you're going to do is going to have you look at two investments, and you're going to decide which investment is the better investment. So here are our two investments. We have a 10-year bond, and that bond is going to give us a pre-tax return of 4%. Or our other investment is that we're going to purchase land. We're going to hold it for 10 years and then sell it, and we're going to get an appreciation of 8% pre-tax on the land. Now we have a marginal tax rate for this taxpayer of 25% on ordinary income, which would apply to the bond. The income we receive on the bond would be ordinary. And we have a capital gain tax rate of 20%, which would apply to the land because that's a capital asset. So the first thing that we have to do is that we have to understand how to calculate the amount of the accumulation on the bond. Okay, so the bond is going to get us, it's a $10,000 bond. I didn't put that here in my information, but we have a $10,000 bond. And that $10,000 bond is going to pay a return of 4%. So we're going to just do 1 plus an interest rate of 4%. So we'll do 1 plus an interest rate of 4%. Now, if I did that calculation, and let me just go back in and edit it. First, I'll do it this way. And then I'm just going to come over here. I'm going to copy the calculation so we can get the math. Of course, it doesn't like me. Okay, so we have a couple flaws first in our calculation. So the formula right here that we used, this is only going to get us interest for 1 year, but it's going to be a 10-year bond. So that 10-year bond, we're going to need to take that amount, and we're going to need to raise that amount to the 10th power. We need to raise that amount to the 10th power. And I'm just looking to see if I can figure out how to write that so that you guys will understand it. Okay, so we're going to do that. So we're going to have to raise the interest to the 10th because we're going to be earning interest every 10 years. So I am just going to do that here. Okay, excellent. Okay, so this would be the amount of our bond, not considering any taxes in our situation. Okay, not considering any taxes. But we know that we're going to be taxed on this bond annually as we earn interest. And the amount of the tax is going to be an ordinary income. So I have to modify my formula here in order to allow for the marginal tax rate of 25%. And so what I'm going to do is I'm going to take that 4% interest rate that I have, and I'm going to adjust it for the tax rate. And so what I'm going to do is I know that I'm going to pay a 25% tax. So that means that 75% of that interest is going to be accumulated on the bond. So let's look at this example of what I'm doing here. So let me show it to you. Okay, so remember our interest rate is 4%. And of that 4%, 25% is going to be taxed. So we have a 75% of the 4% left to be accumulated onto the bond amount. So the calculation here is going to get us the amount of the bond accumulation after tax. So if we have a 4% tax rate and we're paying 25%, 75 or 4% interest rate and we're paying 25% tax, then 75% of 4% is going to be added to the bond every year in interest for 10 years. So let's go through and let's get this recalculated here. So now I'm going to add in my interest rate or my tax amount. And I'm just going to make sure that I have enough parentheses here, and I'm doing all of my order of operations correctly, so it does look like it's good. Of course, Excel doesn't think so, so I'm going to let it correct it. Okay, excellent. So now you notice that that number went down, and the reason why it went down was because of the tax that we have on the interest that we're earning on the bond. So this amount right here is the accumulation on the bond after tax. It's the after-tax rate of the bond after 10 years. So now let's look at the land. So it says in the scenario that the land is going to be, again, we're going to purchase, we're going to use $10,000, and we're going to purchase land for $10,000. And we're going to get an appreciation on the land of 8%. Must be Austin economy. So we're going to do that, okay, because remember we're doing our appreciation here, so we'll do 10,000 at 8%. And then remember we're going to hold that land for 10 years. This is an annual appreciation, so we're going to raise that to the 10th power. So that's what my formula would look like if I was doing the calculation for the appreciation on the land. Now let me do that math. In Excel. Okay, so here's my investment. This is what my land is worth after the 10 years. So I've got a great appreciation here. But I have to pay tax on that because, right, I'm going to sell it is what I'm going to do. So I'm going to purchase the land for 10 years and then I'm going to sell it because I want my money out of it. So if this is what the land is worth, we're going to assume that we're going to sell it for this price, but we had a cost of the land of $10,000, correct? That was my initial investment. So if I have a cost of the land of $10,000, then the amount of my gain, I knew it wasn't going to let me do that. Sometimes Excel, you know, it's finicky. There we go. The amount of my gain is going to be this amount, right? The $11,589. So this is the amount that the land is worth after 10 years. My land cost me $10,000, so the $11,000 is the amount of the gain. But we're going to have to pay tax on the gain. We're going to have to pay tax on the gain. And it says that the capital gain is taxed at 20%, correct? Okay, it says it's taxed at 20%. So now I'm going to calculate the tax on the gain. And that's a simple, straightforward calculation. So you're just going to take the amount of the gain, which is the $11,589.25. It's just a basic tax of 20%, so we'll just multiply it by 20%. So I'll do that math here. And so I'm going to pay tax on the gain of $2,317.85. So now I need to know what's the value of, what is the amount of cash? What's my cash effect? Or the accumulation, we can say it that way. The accumulation on the land after we sold it. Well, we have $21,589.25, right? That was the amount that we received from the sale. And we had to pay tax of $2,317.85. So the accumulation that I have on the land after the sale is going to be the amount that I received minus the tax that I paid. And so I'm going to have $19,271.40. So my after-tax amount on the bond after 10 years is $13,439. My after-tax amount on the land is $19,271.40. So in this situation, the land is a better option because I'm getting more after tax than I am for the bond. Okay? Okay, I hope this will help you in working the homework problem. Your homework problem is very similar to this one. But if you have questions, of course, you can post those questions to the discussion board. Thanks.